And I want to talk about but basically we would like to talk about the deep liquidity. We want to talk maybe about how we make this finally, this fragmented liquidity issue solved. And maybe it would be good also to know your opinion on the RWAs, but not on maybe from the builder's perspective, but from maybe some ventures perspective, like you Dai, maybe you can give some words. So please, guys, introduce yourself. Something about yourself, your experience, about the company that you work in, and one fun fact about you, so the community will know. Maybe Alexei, you can start.
How much time do I have?
Okay, no, not
Very
that
short.
much.
So hi, I'm Alexei. I'm the co-founder of Bob. Bob is a hybrid chain. We focus on combining the best of Bitcoin and Ethereum, and ultimately building the gateway to Bitcoin DeFi, so providing access to Bitcoin yields securely on Bob, but also access to Bitcoin DeFi on all chains. I've been in crypto for 10 years now. You could call me a Bitcoin maxi. I've really worked on Bitcoin ever since I got in, but always trying to build additional functionality for it and make it more useful. Fun fact, I passed on the Ethereum ICO because I thought Namecoin was going to be better, and that's how I learned not to be a real Bitcoin laser maxi, I guess.
Thanks.
Cool, yeah. Hi everyone, I'm Hilmar. I'm one of the founders of Arrakis, also previously founded a company called Gelato that's doing Web3 infrastructure at Arrakis. We help token issuers create deep liquidity on chain for their assets. So yeah, we run market making strategies on top of any sort of AMMs, decentralized exchanges, Solana, Ethereum, Base, Arbitrum, whoever you want. And yeah, glad to be here.
And fun fact.
Fun fact is like a fun fact. Yeah, I did so many. I sold too many. I sold Aave at 80 million FTV.
Oh, that's not fun. That's sad fact.
It's just sad.
Thank you. The floor is yours.
Okay, nice to meet you. I'm Yudai from Fractal Ventures. Sorry, there is no in my name, but it's decided in 2 minutes ago. I will just speak here. So sorry, sorry, I just feel bit of confusing and nervous. But also I'm running a incubator based in Japan, which is the name of Fractal Ventures. I'm running over 4.5 years incubating stuff in Japan, and also my background is also a startup incubator and accelerator based in Tokyo. So since then, we have been providing or how we can create a strong ecosystem and a more founder-friendly and a founder-centric approach as well. The fun fact, is I'm a super coffee geek. I always purchasing coffee beans in every country when I'm visiting. So in my house, maybe 10 unpacked coffee beans is waiting for me. So my girlfriend said, do not buy new coffee beans. So yeah, this is a fun fact.
Thank you. Yeah,
cool. My name is Wee Hao. I'm founder and CEO of Toka Labs. We are a prop trading firm specializing in DeFi. Right. Fun fact is I'm still trying to find the keys to the Dogecoin I mined all the years ago. I don't know where I put them. Still looking.
Thanks a lot, guys. So the introduction was done. Right now, we see how basically DeFi evolving from the retail native platforms into the institutional grade. And I prepared the question to you, Hilmar, regarding the basically how does programmable liquidity evolve beyond the DeFi native AMMs, and can it serve RWA's treasuries at institutional scale? What's your vision on here?
Yeah. So maybe to give a quick overview of the current DeFi or AMM or DEX landscape, I think we are still very early in the life cycle. I think if you go to the DEX-SEX ratio, I think we are roughly at 20% in terms of volumes facilitated by decentralized exchanges versus centralized exchanges. I think this number is also not really, for spot trading, I think this number is not really correct because you have to take it with a pinch of salt because there's a lot of meme coin volume in there, right? Where most meme coin volume actually sort of still happens on Pump.Fun and decentralized exchanges, especially early on. And so if you take this out, then actually we are way less than 20%. So very, very early when it comes to on-chain volumes. And so there's massive growth potential, especially if you compare to whole of TradFi, right? Not only crypto. And yeah, if you look at them different asset classes, you have the blue chip assets. They actually, if you look at where the retail flow gets filled, they actually evolved where most of the volume is not being filled by AMMs or decentralized exchanges anymore. They are mostly filled by RFQ-based systems or dark pools on like Ethereum or Solana or elsewhere. So all of the blue chip assets where you can run like profitable market-making strategies where you can hedge on other venues are also like done by professional market makers. Yeah, if you look at like a blockchain, I look at a blockchain as like an exchange, and then decentralized exchanges like AMMs or RFQ systems and so forth, they're just market makers on this exchange that have certain quoting strategies that are less sophisticated or more sophisticated. Yeah, then you have like all the like more project tokens, like the governance tokens and so forth. They usually still use AMMs. They service quite well in that. It is also where Arrakis like operates, and they are the primary customer group of ours. And then you have yield-bearing assets, RWA, stablecoins, and so forth. And I think they actually benefit a lot from DEXs or AMMs because for them, running like a very sophisticated sort of like market making strategy is not that important because they're pretty pegged to either other assets or to the US dollar, and they only like drift in a certain sort of like deterministic fashion usually. And if you think about market making strategies, I actually look at them more as yield strategies. So AMMs are like a very basic form of yield strategies for RWAs or yield-bearing stablecoins, and the power of blockchains is actually composability and not efficiency in terms of like performance and speed. And so with composability, you can combine market-making strategy with so like lending and borrowing strategy. You can loop these things together, and you can create really sophisticated yield strategies for that at the same time provide you with like strong liquidity for this asset to redeem them against stablecoins. I think we're very early stages there because most RWAs like treasuries and so forth, they are still like whitelisted, KYC'd. So you have to generate wrappers to actually make them tradable. But I think it will all. If I talked to a lot of like security issuers here in Token, and I think where the industry is moving is on-chain first issuance. And then permissionless access. So you can put them into AMMs and you can generate really interesting yield strategies that now are not only accessible by sophisticated market makers, but you can put them together into like really cool yield applications for like Ethena did for the basis trade. So I think that's the future we are heading, and these yield opportunities will be accessible by anyone, and they create liquidity as a side effect. So I think that's super cool.
Very insightful, and maybe you want. I saw you like was agreed on the most of the things that Elmar shared. Do you want to add something on that topic?
Yeah. I think I generally agree, right? Okay, I think we always go back to the fact that, where is the price discovery for those assets, right? So for example, let's say it's packed assets, right? Let's say there are different variants of stablecoins. They work very well in the pool itself, right? You don't need a secondary price discovery source, right? But let's say it's something else where the price discovery is actually elsewhere. Let's say your stocks, right? Okay, so for those, running them in AMM pools is probably a bad idea. You're just creating a venue for people to arbitrage you, right? You actually would want to rely on things like, let's say, RFQ, right? Because they are basically just mirroring liquidity from elsewhere, right? But there are always, obviously, native, crypto assets, right? Meme coins is one of them, where the price discovery is not elsewhere, right? I think these ways AMMs works very well, right? So I think there's a spectrum. We need to know what assets works best where.
Yeah, and basically, as a trading firm, how do you evaluate where to deploy the liquidity? Basically, maybe you can share some kind of general things that you are checking before.
Correct. So I think for us, right, trading is actually more about risk management, right? So we need to know what kind of risk we're actually taking, right? So I think the first thing that we always do is we try to assess what is the risk of a particular platform, right? Is it open source? Is it closed source, right? Do we even understand what is the mechanics behind, right? There can be some very cool, curves behind, but do we actually understand the mechanics, right? So only after that, then we decide if we actually want to deploy capital or not, right? Now, in the event that, sometimes it may not be open source, right? I will not say what protocols, right? They may be closed source, right? Then in that case, we kind of take a more, I would say, social approach, right? do other people actually trust them, right? Are they actually putting funds in, right? So it's actually very dynamic. But at the end of the day, I think we have to always monitor what's going on, right? So for us internally, we actually monitor whether is it an open source audited project or is it a closed source project, right? We actually monitor what we see as deviations from expected behavior. The moment we see something is wrong, proper risk management entails that we try to exit as soon as possible. So I think this is how we look at it.
Yeah, thanks. Anyone wants to add something here? We see right now in the news there are basically big news around the investment in the biggest RWA's project. Maybe you can mention some your thoughts on those big announcements on the investment and basically your general strategy as a VCs on how you are evaluating their projects. What is it the big trend? What exactly is happening in terms of the venture on the venture side? And you guys maybe can comment in terms of your basically vision on this.
Yeah, I think or as I operating an incubator based in Japan for Asian founder, Asian market, I always thinking about where is a good timing to bringing a lot of money to Asia. In the Wall Street, it has already happened. So in Asia, there's a lots of still TradFi players still thinking about where is a good timing to put lots of money into DeFi market or on-chain market, and what type of asset class or they can believe, or this is a believed asset class level, and as I don't know, in the States, there's a lot of TV or any other tokenized asset class. Is really easily to everyone can put money into this, but in Asia, there's only few small stable coins they are in, and also we could see lots of synthetic stable coins collapse in past. So the market is really afraid of where's a good timing, where's a really believed asset class, and we have to put the money. So and I'm super interested in the the stablecoin regulations in Japan. Or recently, Japan has finally approved the first stablecoin. It's called JPYC from Japan. And so for directly connecting to liquidity issue, so from Japan, I think after coming to stablecoin, regulated stablecoin from each of regional market from Asia, we will see more liquidity into DeFi, right? So so I think this is really important things to do this. And also I'm just a bit of a maxi people, so I'm super careful about a ratio between one by one asset class, or as a circle USDT model, or a more synthetic asset class as a SDAI, or now it's called USDS, and or any other synthetic stablecoin. So we have to keep are holding both type of asset classes in stablecoin area, so that maybe institutional will come more and bring more money, and we cannot say stop, but after that we also try to use the technology to create more unique approach of stablecoin in the market, and both liquidity will keep providing into DeFi is a very necessary need. That's the things I always thinking recently.
And guys, quick question to all of you guys. What are missing in DeFi to basically attract all these big asset managers to start basically properly use DeFi? Maybe you
I mean, we work a lot with Bitcoin, right? Which is obviously the biggest non-stable coin, digital asset. And what we definitely see is two things. Obviously, risk is obviously one of the biggest concerns. People are very conservative. The moment you start talking to more institutional funds, the first question is okay, what's the risk? Is it native? Who has custody? And also obviously, they prefer bigger protocols. That's why you see a lot of concentration around really big players like Aave. Obviously, Morpho's catching up. You have Uniswap, and obviously big players also 1inch. They see a lot of capital concentration basically in usage, and unless you're hyper liquid or a very high project like Lighter, it's very difficult for you actually to attract capital, especially from bigger players. And you have to basically, we're talking about liquidity wars incentives. You have to go into these incentive wars and fight against everybody else, and essentially, you're probably burning through a lot of money. And I honestly think the other problem is still size. Bitcoin yield, and again, I can always offer the perspective from the Bitcoin side. Everybody wants Bitcoin yield. Bitcoin is the biggest asset, and the problem is that since Bitcoin is bigger than all the other digital assets combined, there is just not enough yield to actually saturate the demand, and that's why people start looking for option opportunities. The growth of like Hyperliquid, Aster, Lighter, of course, offers new opportunities, but it's still like always a question of like, is it like really full on-chain DeFi or not? And what we see actually happening is the creation, I guess, of these hybrids, which offer you like better execution times and like better price discovery, and just you get closer to like high frequency trading at the trade-off of decentralization and transparency naturally. So I honestly think that's where it's probably heading, and players who are able to position themselves there and make these trade-offs, but still build trust will likely benefit most from liquidity. Because honestly, I think AMMs are great, and we always see like new curves being developed. But again, I think that speed and also size and like price discovery seems to be still like converging towards like off-chain trading, and where I think honestly Hyperliquid probably I mean, we can argue whether it's full like actually a decentralized or centralized protocol.
Any
Yeah, from our conversations with the TradFi players, right? I think they're actually just dipping their toes in. Why? Because they haven't seen model examples, right? Successful cases. They're actually waiting for someone to show them the way. Right. So actually right now, nobody wants to be the guy who sticks his neck out just in case something goes wrong. So in our conversation, then they've been asking like, okay, what works, right? Can you show us something that works, right? If there is, we're happy to, replicate it, right? So I think there's a lot of, money ready, right? I think they already know that there are opportunities here, but just waiting for someone to show their way. So I think at least we're working with a lot of players, both TradFi and DeFi, we're trying to get something out. Then hopefully that will create this, cascade where everybody starts realizing that yes, this is the future of finance.
Yeah.
Go. So maybe just to add like one thing, since we talked quite a bit about AMMs, I do think like one big unlock will be RFQ-based systems, because with AMMs ultimately, it's very inefficient for bigger LPs to keep capital in there. Market makers don't like to provide liquidity. In RFQ-based systems, you don't have that problem. I think that's just much more attractive to TradFi players who can then decide where they provide capital and which orders they take, and it allows them to actually play both on centralized and decentralized platforms at the same time.
Yeah, one insight that we can share on the OneInch side. So we have this fusion mode that just switched on also the opportunity to do the RWA assets, and that opened basically the market for us for the self-custody wallets like Binance wallets or OKX wallet, BitGet wallet, start using this RWA, thanks actually to Toka Labs as well by providing the liquidity. So we see the traction on the self-custody DeFi side. People start using, like we're getting like at least 1 million in volumes every day. And then basically having this showcase with the fusion where we have basically DeFi gateway with different APIs and RWA options, we start pitching into the banks, and the feedback that we're getting is basically not just the volumes, they're also really caring about the compliance part. Why sometimes they don't even asking us about the licensing because they're ready to operate under their license, but they really want to make sure that all this liquidity that is happening is very clear and transparent and compliance part. So that's something that I don't want to comment, but that's something that we all have to pay attention on. And the second part is basically to support the technical solution that they're going to plug in. So my dream is basically having the neobank where we have two options. The options where you have the bank card or like any assets that have in the real world, and then basically DeFi option where we can trade in a self-custody way all the digital assets. And the thing that they also really care about is that they are not really professionals in this space. So, and DeFi protocols in most of the cases are still kind of startups that they never worked with a corporate mindset. So and now it's it's the moment when you have to think in a corporate way to make sure to support all these millions of users as well. Yeah, we have a cool option, but then when these billions of users come to use your solution, are we ready for that? Are we ready? Basically, the solution is ready. The support is set it up. Like everything that we have to really pay attention on. But I'm glad to share this because now we see this interest and we start talking seriously. And this is hopefully will happen in the upcoming next 5 years. Guys, I want to make this conversation more maybe kind of energetic basic, I believe you have all the professionals here to answer your questions. Raise your hand if you have any questions regarding this topic, or basically there is a Toka Labs, Fraction Ventures, Arrakis, and Bob who can answer your questions if you have some insights, or basically share your insights right now. We still have some time, or maybe you can ask the questions and do your customer development to the community. Raise your hand. You don't have any questions. Why are you here then?
I mean, if there are no questions, maybe I think we talked quite. I found the title actually very interesting, but I feel we haven't quite touched as much on the liquidity wars that we see in crypto right now. As a chain, obviously, every chain is looking for liquidity, and you see this constant incentive programs. Plasma launched, and they're spending what I think $4 million a day plus on incentives. And I find it like from our side as a chain, right? Obviously, as a newer player, you don't want to go like toe to toe with like a Sui, Apta, Solana, who are obviously much bigger, and it's just a waste of resources. And it's quite interesting, probably also for probably a lot of players come to you to look for solutions like, hey, how can we attract liquidity? And probably Toka Labs is obviously very good at navigating where do we get the best yields. And I guess what we see is actually, it's like the last word here is collaboration. I actually don't see this being a collaborative approach at all. And actually what we're doing right now is vampire attacking each other with vaults. So we have vaults we're going to have vaults on Bob that basically are to deposit BTC, and then it just goes into all these other chains. And, we offer users to, farm all these other incentives because, well, why not? And then you allow you to use these LSTs for something more useful. I guess, Arrakis is probably also in these conversations and you're probably also fighting for liquidity, but also you're part of chains fighting for liquidity. I don't know if I'm allowed to ask questions, but I guess
Please, we're here to talk.
how do you guys, from your perspective, do you see this constant, one option is there'll always be more chains. So, one chain runs out of money, the next one comes along. But, eventually this is a bit of a race to zero where you have just this liquidity moving around and, not much new liquidity moving in actually.
I think I have one comment. Normally we can only track a TBL number of TBL. So it means you say I'm completely agree. This is we are just doing just a vampire attack from new chain has come means a new chain get liquidity from somewhere. So it's why we are keep doing more zero sum game. Why we cannot start plus sum game. So maybe calculation ratio is calculation way is a wrong way to do this. Only we can track TBL. TBS is higher. It's good. Why? So why money is come from chain A to chain B, chain C, and cycling again. So why we can push this type of incentive to do this? So maybe the type of our transaction normally cannot trace on main majority our analysis side. That's the reason I think so. So we have to change the calculation way to how much cycling the liquidity in the market.
Yeah, I think. I look at blockchains as exchanges for most of the part, and what really matters on an exchange are the volumes and not the liquidity, right? Liquidity is kind of like a necessary evil in order to actually attract volumes, but what you really want are retail order flow. You want retail order flow because retail order flow creates yield, organic yield, and it then incentivizes market makers to come in, right? Toka Labs will probably go where people trade, right? And if you have a chain, even if you have a great liquidity campaign, such as these new stablecoin L1s that are launching, if you don't have adequate liquidity to actually facilitate, if you don't have order flow that want to settle on your chain, then this liquidity is just there and it sits idle and it is not really being used, and at some point it will flow off. And I think the reality is that it's also path dependent. So a lot of people started with the assets on Ethereum, right? That's why Ethereum still has the highest volumes. With Solana these days, of course, if you take meme coin volume out, then Ethereum is basically the largest. And that's why most people still trade there, right? And you need to first move some liquidity over to then create the environment for then people to trade. But then it's not only the liquidity, you need to have wallets and distributors actually route their users to have to on-ramp their assets to this new chain, this new environment, first and foremost, versus going to Ethereum. And then they start like organically trading there. And this then creates like the necessary building blocks to have like a long-term sustainable liquidity incentives there, which is not just paying you from like some tokens, but like actually like retail order flow. So I think it's just very difficult, and the more chains there are, the more competition is around like attracting that liquidity. So I think you need to focus on attracting order flow rather than the liquidity. And if you have the order flow, liquidity usually comes.
Yeah. I think the way we see it, right, is that, a lot of the liquidity incentives today are just like marketing spend, right? You have to spend it, right? But you need to get something out in return, and I think people forget about that, right? What are you actually getting in return that's sticky, right? I will, for example, let's say Google spends, on acquiring users, or let's say a centralized exchange spends on acquiring users, the user actually stays, right? Which means they can continue to contribute, the marketing is well spent. But I think a lot of times now, if we see in the DeFi space, a lot of this liquidity incentives after it's spent, that's it, right? Everyone just move on to their chain, it's not sticky. So I think this is a problem. So at least as a trading firm, in a way, it's good, right? Because that means now there's a lot of market inefficiencies. We get a lot of trading opportunities. But obviously, we're also concerned about, how long this is going to last, right? Once the VC money runs out, probably not going to last very long, right? So I think what we're more interested in is, finding DeFi protocols, right? Innovators, right? Like the ones that we have over here, right? They're actually trying to bring in new ways of doing things, right? That's actually creating value. And these, I think, are sticky, right? So there's reason why, people are trading on Hyperliquid now, because they created something that they like, this sticky behavior. And I think with a lot of upcoming ones, I think people are slowly realizing it. I think this is what we need to make DeFi going forward.
Great. Did you get the question?
Yeah, I mean, yeah, definitely. I mean, maybe one thing to add in, like, as you say, it's marketing spend. And what we definitely see is like, this high, the cycle of, pump TVL, token launch, and then TVL death, where, people just realize, okay, liquidity flows out and there's nothing left. I mean, that cycle has been accelerating, and we've seen that quite a bit, unfortunately, also in the Bitcoin ecosystem, where you have like a lot of stale capital put in, nothing happens. And especially in BTC, there are a lot of self-custody TVL deals where, like we've seen this at the very beginning of the Bitcoin cycle, where, Bitcoin actually never was really, on chain and used, it's just like locked in a custodian. And unfortunately still, TVL is, however, a vanity metric, and for chains, and I fully agree, who cares about liquidity if it doesn't do anything? Well, it still is actually used as a metric. So I think, until we get rid of that and people start seeing chains, I guess, more as exchanges, or like really like, okay, how many users do you have? How many transactions? What are people doing? Until people realize that that's the whole purpose, it's going to still, we're going to have this continuous cycle. And I think there's a lot of entities that have incentives to keep it that way.
I think the reality is that it's like a two-step. If you want to launch a successful chain, you have to solve two things. First, you have to have this massive marketing campaign and attract a ton of liquidity to solve the chicken and egg problem, even though there's nothing going on in the chain, right? Which is very hard. I think only a few players actually execute this really well, because they have really strong marketing people in their team. And then, okay, you solve problem one, you got some liquidity, and then, okay, now how do you get the distribution and the order flow? Like, how do you actually get people to start trading on your exchange, on your blockchain, right? And this is, I think, even harder than the first problem, but usually you can only get to that problem if you solve problem number one. And there you need to potentially build a wallet. You need to build a novel application, like a pump.fun, right? You actually need to build something that people want to use, and then issue assets on your chain and start trading. And I think that's the even trickier part, that not Base did that successfully, but it's also backed by Coinbase, right? So they have the resources to push this out. So it's a very, very challenging problem. But if you solve this, then of course there's a high price to be gained.
Yeah, and that's what we're going to discuss on the next panel. Thanks a lot for our beautiful panelists, guys. If you have questions, the speakers will be around, so just go and pitch and talk to them. Thanks a lot, guys. And yeah, big applause to our speakers.